You've probably heard of capital gains taxes before, but you might not know exactly what they are or how they affect you. Hi, I'm Caitlin with Legacy Title Agency, and today we're going to talk about how your next sale or your client's sale of their home can end up with some capital gains tax consequences. So what exactly are capital gains taxes? Long story short, this is the money that you're going to pay to the IRS whenever you make money on the sale of an asset. And because we want to keep things just a little more complex, there's actually two types of capital gains taxes we can pay. There's long-term capital gains and short-term capital gains. So we're not going to focus a ton on short-term capital gains taxes today. And those taxes are the taxes that we pay if we've only held the asset for less than a year. So if we've held it for more than a year, that's what's categorized as a long-term capital gain. Less than a year, it's short. More than a year, it's long. So the reason why we're not going to focus on short-term capital gains taxes is actually because those short-term capital gains get taxed just the same as ordinary income. The IRS doesn't really think they're that special, so they don't get a lot of special rules. We're going to focus on the special ones today. So that means long-term capital gains. So again, capital gain is something where we've sold an asset and we've made money. So let's look at an example. Obviously, we're talking about real estate today. So let's use that example. If I buy a house in 2009 and I buy it for $400,000, let's say I put $25,000 into it. That means that my new adjusted basis is $425,000, okay? That's the amount of money I've put into it. Adjusted basis is a really nice fancy tax word. We just have to know that one. Now, if I sell my home this year in 2024, bear in mind that a lot of the tax brackets and things change every year. So as you're looking at these numbers, always keep in mind that today we'll be looking at 2024 numbers, but that's based on the year that you're selling the asset. So if you still haven't filed 2023 taxes and you sold that asset in 2023, that's a different set of brackets. But moving forward, if we sell something this year in 2024, these are the brackets we're going to be looking at. So if I sell my home and it's $550,000, I'm going to subtract the amount of money I've put into it, which is my net adjusted basis. And I also get to subtract closing costs, which is nice. I'll take it, right? So that means I have a capital gain of $120,000, okay? I bought a house, put some money into it, sold a house, the amount of money I made, that's my capital gain. Now, if I'm a single person and I make $80,000 a year, I'm going to come over here to this little bracket, and it's going to tell me that as a single person making $80,000 a year, I'm going to pay 15% in capital gains taxes. Now, if I make less than $47,000 and $47,026, I'm actually not paying capital gains taxes at all. Yay, that's great. Now, if I make more than $518,900, I'm actually paying 20%. So that's a bummer. I mean, it would be nice to make $518,000, but I'm going to pay 20%. So I know I'm right here in this middle tax bracket. I'm single, make $80,000. So that means I'm going to pay 15% on that $120,000 capital gain. Okay, so what I'm going to do is I'm going to take that 120, I'm going to multiply it by 15%, and that tells me I owe $18,000 in capital gains tax. Boom, easy, we're done. Just kidding, we're not. So what else do I have to pay? Also state capital gains tax, which is the same as our ordinary income tax. So I take my 120, I multiply it by 4.25, because in 2024, it increased to 4.25. So I take that 120, I multiply it by 4.25%, and that equals $5,100. So boom, done. Easy, right? Well, not quite that easy. There are some other fun factors. So I gave you an example with a single person making $80,000. You can see that there's actually a couple of different tax brackets. Okay, so there's for married people filing jointly, single people, heads of household, married filing separately, and then also estates and trusts. Everybody is going to pay a slightly different, they're going to pay either 0, 15, or 20% on their capital gains based on the bracket that they fall in. And you'll notice they're all just a little bit different. And they fall in line kind of similarly to how the income tax brackets fall, but they are not exactly the same. So the real question, right? We can do the math. Math's not that hard. But geez, Caitlin, like, when am I actually filing my capital gains taxes? When do I pay them? When do I figure out how much I owe? Like, how the heck does this work in a real estate transaction, right? So you might not even realize this, but the dispersing title company, so the title company that's responsible for handing out all the money, they are the ones who are responsible for telling the IRS that there may or may not be a transaction with potential capital gains tax. Okay, so they're going to have this document. It's called a 1099-S. It's a very specific document. All right, it is a reporting document. And what they're going to do is on certain transactions, they're going to let the IRS know, hey, this transaction took place. Okay, now, not every transaction, okay? If you've ever seen this really cool document, it's called a certificate for no reporting, yada, 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 yada. And it's got all these really cool questions, true, false. And you're like, oh man, this is confusing. That document is actually helping the title company determine whether or not the 1099-S has to even be filed. Now, good news, bad news. The IRS actually creates that document. So we have to actually use that exact format in our industry, and we've got to take that information, and then we also are going to turn around, figure out what it's telling us, and then decide if we're filing that 1099-S. Now, if you'll notice, that 1099-S form is pretty small. There's not a lot of information on it. What are we even telling the IRS? We're telling the IRS the seller's name, we're telling the IRS the seller's social security number, and we're telling the IRS how much they sold it for. But there's some things that are not on that form, like, I don't know, how much capital gains the seller had. So when we're filing that form, we're really not even giving the IRS a ton of information. We're just saying, hey guys, just an FYI, Bob over here might owe you some capital gains taxes. You'll find out next April. Okay, so what's going to happen next year when Bob goes to file his taxes, he's going to sit down with his tax professional and say, hey, I sold my property. And they're going to look and they're going to figure out exactly how much he had in capital gains. And they're going to look, did he put money in the property? Did he not? How much did he buy it for? How much did he sell it for? They're going to go do that math that we did. Okay, then when he goes to file his taxes, they're going to list on there exactly how much he had in capital gains. And based on his income bracket and everything like that, they're going to determine how much he owes to the IRS. Okay, so that's something that the seller does when they file their taxes. So a lot of times, and this is a really great pro tip for us as realtors, a lot of times we have clients that come to us and they panic about that 1099 at the closing. And they're like, on here it says the sales price and that's not how much I made in capital gains taxes. And they're like, I don't want to pay capital gains tax. I don't want to pay 15% on $500,000, right? And we just need to know, don't worry. That's not what that document is saying. It's just a simple heads up to the IRS. Hey guys, Bob may owe some taxes. this is how much he sold it for. That's all we're doing. Nothing too exciting. So, good news. As with all things in the tax code, there's a lot of rules, but with rules comes exemptions. We love an exemption, especially for taxes, right? So, because we have that certificate of no reporting, which means sometimes we don't even have to tell the IRS that a property was sold. And the reason why we don't have to tell the IRS, hey, Bob might owe taxes, is because we can very, very clearly see, based on that certificate of no reporting, that he's going to fall into an exemption. Now, if he fills out that certificate of no reporting, we look at it and we're like, we still have to report this. It doesn't mean he doesn't qualify for an exemption 100%. It just means we have to report it and later they'll have to make the determination. But if it's really clear to us at the time, then we don't have to report it, right? So now let's look at what it looks like if we have this exemption. All right, so we're going to look at basically the same exact example, but now I'm married and I'm filing jointly. We make about $180,000 a year. Same thing, buy it for $400,000, fix it up for $25,000. Now I'm in at $425,000, sell it for $550,000. My net adjusted basis, remember that was $425,000, closing costs $5,000. I'm at my capital gains at $120,000, right? Now, if we're exempt, I get an exemption of up to $500,000 of capital gains. So am I going to pay any federal capital gains here? No. Yay, we love this, right? This is what we want. Now, unfortunately, we do still have to pay state capital gains taxes, but we don't have to pay that yucky 15%, which is a definite W for us. Okay, so FIRPTA. We've all heard the 6-letter F word, FIRPTA. And that, we're always wondering, what the heck is FIRPTA? Well, it stands for Foreign Investment and Real Property Tax Act. Okay, so this comes straight from the IRS again. Why are we talking about it when we talk about capital gains taxes? Well, we have to understand what the heck FIRPTA is. So FIRPTA was invented by the IRS as a method to ensure that even individuals who didn't live here in the US, maybe weren't US citizens, et cetera, we want to make sure that the federal government still gets their taxes even if this person doesn't live here. All right, so what are we going to do? We're going to create FIRPTA. All right, we want to make sure that we can get those capital gains taxes from everybody, even if they are not a US citizen, even if they're a foreign person. Okay, so the one thing we want to think about, remember, we don't pay actual capital gains. We don't calculate actual capital gains until we're going to pay our taxes, right? And we actually file our tax return. So we have to know the difference between a withholding and a tax, okay? So when we decide, hey, Caitlin owes $50 in taxes to the IRS, that's a tax. But every week when Caitlin gets her paycheck, or every other week or whatever, the IRS can withhold taxes from her paycheck in anticipation that Caitlin's going to owe us some taxes. It's just a guesstimate, right? We're just guessing how much taxes might be owed. So we're going to withhold a chunk. The IRS is going to hold on to it. And then later we'll figure out how much is actually owed. So when we're talking about FIRPTA, we're not talking about an actual tax being determined necessarily. We're usually talking about a withholding. All right, so what the heck does that look like? Well, the IRS determined that it's going to be really important that we can keep track of all of these transactions and make sure everyone pays capital gains taxes. And a lot of times we ask the question, oh, does FIRPTA apply to this transaction? And the answer to that is always yes. FIRPTA applies to every transaction, right? FIRPTA actually applies to every transaction, and the real question is there an exemption to where this FIRPTA withholding doesn't have to be made? So FIRPTA tells us, hey guys, if you have the sale of real estate, you need to submit a 15% withholding to the IRS. Okay, so if there is a sale of real estate, everybody has to submit a 15% withholding to the IRS, right? And we're like, whoa, wait a second. We haven't been doing that, right? Well, that's because FIRPTA also gives us exemptions, okay? So, everybody has to submit a 15% withholding to the IRS unless one of two things is true, all right? First option is that the seller is not a foreign person. We will come back to what a foreign person is. But the first time we have an exemption, we don't have to pay in that 15% off the bat, is if the seller is not a foreign person, okay? Option 2 is that the buyer is using the property as a principal residence and the sales price is under $300,000. So it's $300,000 or less, and the buyer is going to be using the property as their personal residence. Okay, so if it's not one of those two things, seller is not a foreign person, or buyer is using it as a principal residence, and the property price and the purchase price is $300,000 or less. If it's not one of those two things, gotta pay your withholding tax. Usually it's 15%. Okay. So the IRS tells us it always applies unless there's an exemption. Now, we have some pretty strict rules about how we have to document the exemption. So have you ever had to fill out some kind of confusing tax forms? I'd be very surprised if any of you said no. But we know that there's a FIRPTA form actually for the buyer and the seller that we can sign at closing that memorializes these exemptions, okay? So our buyers and sellers, well, our buyer or seller has to fill out one of these exemptions. Otherwise, that withholding needs to be made, okay? Now, if there has to be a withholding, of course, and this is going to be a surprise to no one, there's going to be more tax documents that get filled out. We're looking at a Form 8288, a Form 8288A, which by the way has 3 parts, A, B, and C. It's going to be super fun. I also highly suggest if you have a client who might be subject to a FIRPTA withholding, meaning they don't fit into one of those two exemptions, they are a foreign person according to the IRS, right? Or the buyer's not using it as their personal residence, and it's, and or it's over $300,000. There are specific companies that can advise you on exactly how to do this process as seamlessly as possible and make sure that we're doing it in a really safe way for our sellers. Okay, because it's ultimately the sellers that are gonna have to take their check and send out 15% to the IRS. So let's take a look at a couple important questions. Number one, who is a foreign person according to the IRS? Okay, we can very easily see a lot of these designations are what the IRS considers a foreign person. And then we get down to the bottom, resident alien, we do know for sure, is not a foreign person, okay? So a resident alien does not necessarily need to file a FIRPTA withholding. And then we have this great, brilliant scientific test. And it is lovingly referred to as the green card test. If your client has a green card, usually they don't have to pay FIRPTA tax. It's very scientific. Do they have a green card or not? And a lot of people ask me, hey, what does a green card look like? So here's 2 really great examples. They are example green cards. They're not pictures of someone's green card, but that's what they're going to look like. So let's get into more of the nitty-gritty on exactly what FIRPTA is going to look like and feel like, especially for our sellers. Okay, so let's use our same example. Single person, $80,000 a year. Same math brings us down to $120,000 in total capital gains. We're very familiar with this number, right? And normally I would need to go over and calculate my 120 times 15, and it would tell me how much tax I'm going to pay. But with FIRPTA, that's not what we're doing. With FIRPTA, what we're doing is we are taking that $550, the sales price, and we're multiplying that by 15%, and that's the withholding, okay? I don't care what your capital gains was. Nice math doesn't matter, okay? The IRS says we're going to take that $550, the sales price, that's the number we're using, multiplying that by 15% or potentially 20. And that's going to get us to a withholding of over $87,000. And so our client is going to have to take that $87,000 and send it straight to the IRS. And really, they're never even going to touch that money. The title company is going to take that and they're going to send it straight to the IRS. It can't be held in escrow or anything like that. It actually has to be sent directly to them. So if we have a potential FIRPTA situation, we want to make sure that we address this as early as humanly possible, because our seller probably does not want to just give up 15%. They probably don't want to just send that $85,000 plus check to the IRS. All right. That doesn't really sound fun for any of us, particularly if the seller wants to, I don't know, buy another house. They probably are counting on that money. So that's when we do have some other alternatives, okay? And this first one is called a withholding certificate, all right? Now, the IRS gave us this option to do a withholding certificate, and it was very, very kind of them. They were like, okay, don't worry, you don't want to do a withholding. I totally get it. We'll give you this option to do a withholding certificate. And what will happen is you'll file these documents with us, and instead of us making you do a withholding, we will determine exactly how much money you owe on the front end, and you just pay us what you owe. Sounds like a good idea, but in reality, it's usually not so easy, because first of all, you have to already be under contract. You have to have a purchase agreement in order to file for a withholding certificate, okay? And you usually need a relatively skilled tax professional to handle this for you. And the IRS tells us it takes about 90 days, all right? So if your client is dead set on going the route of a withholding certificate where they get a definitive amount that they have to withhold, we probably need to work really closely with our buyers, and we probably need to work really carefully on setting appropriate expectations about how long this closing process is going to take, because most people who agree to buy a home aren't prepared to sit around and wait 90 plus days for our seller to receive this withholding certificate. Now, there is one thing as well. You do need a tax ID number for this withholding certificate. Now, if you don't go the route of withholding certificate, you just want to do the FIRPTA withholding, a lot of people tell us, oh, our client, our seller, myself, I don't have a tax ID number. Now, we always caution everyone, it's best practice to get a tax ID number. Legally, you do not have to have a tax ID number for a FIRPTA withholding. However, let me set the scene. I'm going to send a check to the IRS for Bob Smith in the amount of $87,000. I'm going to send it in February because that's when I sold my house. Now, come April of next year, I'm going to say, hey, IRS, do you remember that time I sent you a check for $87,000? And by the way, my name is Bob Smith. And what do we think the IRS is going to say? Oh, let me see if I can find that Bob Smith and your $87,000, right? Without that tax ID number, it makes tracking those funds really, really hard. So we've got to be really careful. And it's always, always, always best practice to get that tax ID number before we do a withholding. And it is required if the clients decide to go the route of a withholding certificate. Another concept that we usually think about when we're thinking about capital gains taxes is 1031 exchanges. So this is a method, again, the IRS created this, put it into the code. It's actually section 1031, that's where they get their name. It was created to actually allow us to defer paying our capital gains. So instead of at the time of closing, we now have this capital gain and subsequent capital gain liability. Instead, we're actually able to exchange this property for another like-kind property. And instead of owing capital gains taxes now, I don't owe it until I sell that next piece of property. And then I can exchange that one, and then I still don't owe it. And as they lovingly refer to it, as kicking the can down the road. So you can keep deferring those capital gains taxes on and on. The number one thing to remember when we're working with 1031 exchange, or we're even considering a 1031 exchange, is you have to have a qualified intermediary. This is not a title company. This is a separate entity, okay? This entity, they are referred to as qualified intermediaries. They're going to basically run the show. They're going to tell everybody what they need to do. They're going to keep everybody in line. And the title company is going to ask the qualified intermediary for very specific instructions. So if you are considering a 1031 exchange, the number one thing you want to do is find, interview, talk to a few different qualified intermediary companies, and they will help you answer all of your questions. The next thing you want to think about is actually there's a very specific timeline involved. So you don't want to say, oh, I'm going to sell my house tomorrow. Maybe I'll do a 1031 exchange. We want to put a lot more planning and effort into facilitating 1031 exchanges, not just because you need to find yourself a great qualified intermediary, but also because there's some really strict timelines around how these transactions need to take place. I hope you learned something new about capital gains taxes today. And if you have any questions or comments, feel free to send me an email or give me a call. And if you're looking for a title company who knows how to handle your real estate transactions and has a lot of knowledge in the capital gains, 1031 exchange, or FIRPTA world, please reach out to us. We would love to chat with you.